Hey, good morning. So it's Traderfirstyear here with the 4/13/2020 new options position, which is a bearish risk reversal trade. Will be short theta and long gamma profile to take advantage of the rise in implied and realized volatility. It's expected outperformance over from 4/13/2020 to 5/15/2020. You're taking advantage of a rise in realized volatility and overall market dispersion. You want to avoid the small print. The condensed version of the trade is pretty straightforward. It is a long vol, short front dated options, and long gamma profile. End goal is always to make money. There's potential unlimited upside profit. Exposure of about 180,000 this week is short dated funding to reduce the cost of being long vol. Volatility expectation. I expect the market to move less than 5% plus or minus this week. VIX expectation is about 2.5 to 2.75 to 3.5%, which would represent about a 44 to a 55 VIX. Plus or minus up or down. And Volga VVIX about 7 to 10 points this week. Range on the S&P 500 via VIX is between about 40 to 55 this week. Full summary and rationale for the trade. The start of earnings season, potential peak coronavirus in some states, reduction in share repurchases by large corporations, end of quarter end passive fund rebalancing, along with substantial changes in market uncertainty relating to demand for risk assets, will potentially force the market to revisit lows during the week starting 4/13/2020, ending 5/15/2020. The Federal Reserve credit warehousing, short gamma expansion, and buildup of duration on their balance sheet is unlikely to mitigate structural hedging repositioning from institutional clients. This will provide traders structural opportunities to profit from being long gamma into earnings season. To fund the trade and reduce the cost of being long volatility, traders will assume the role of insurance companies for a week, selling premium, writing policies, and using the funds to reestablish put positions 5% to 8% out of the money on the indices and individual equities listed below. The brief on trading suggestion. We will temporarily be returning to a period of elevated swings up and down, but there is more significant delayed selling likely to restart after April 17th, so going into that next week. The rationale for the trade. The market will revert towards higher levels of realized volatility this week in comparison to the previous weeks. This will present traders with the perfect opportunity to profit from being long volatility. An increase in uncertainty, institutional hedging, market makers re-engaging in high levels of delta neutral hedging, and potential strike risk invite investors to use short calls to fund long vol positions, put positions. Federal Reserve aggressive balance sheet expansion may act as a slight deterrent, but will not offset market structure. I will not likely be issuing any new carry trades or short vol trades in the next few weeks. Those were the short strangles that were typically 5% to 8% out of the money. And you're typically short convexity as well there. The risk for the trade is twofold, and the first funding leg, which would be offset by any increase in realized volatility, which causes the equity market to move up more than 5% to 10%. So it's the right side of the distribution curve is facing substantial risk on that first leg, where you're just you're selling short vol to fund the long put positions here. The second leg of the trade, which is long volatility via 5% and 8% out of the money puts, faces risk if realized volatility falls or remains stagnant from today until May 15th. This would create substantial problems to overall profitability. What we would like to happen is for movement of greater than 8 to 10% down. So movement of 8 to 10% to the left side of the distribution curve is kind of where we're looking at to profit from this bearish risk reversal trade. Two things we would like to see is equities moving. Two things we would not like to see, I guess, is equities moving up 10% or remaining stagnant over the course of the trades. So as you can see, if you look at the list, we have the SPY, the Qs, the Dow, Apple, Microsoft, and then I added for some beta exposure, high beta equities like from the semiconductor sector, which are AMD, NVIDIA, LRCX, and TXN. So as always, good luck on the trade, and thanks for following me. I may continue to do more videos associated with the new trades. So stay tuned and keep following. Thanks.